It has been 6 years ago since the global community adopted the ambition to limit global warming to 1.5 degrees Celsius. But since then, emissions has continued to increase, and pledges submitted under the Paris Agreement is steering us to well below 3-degree warming. The probability of missing the 1.5 degree target is growing, and businesses and financial institutions are increasingly becoming aware over the fact that a business environment in a 3-degree world is not a good one. In response to the growing emission gap, 200 asset owners and asset managers with $50 trillion in asset under management has voluntarily committed to aligning their investment portfolio with the 1.5 degree target. We're talking about a capital base equal to the GDP of China, United States, and the EU combined. A mass movement has started, but at the moment it is running in different direction. For it to have the global impact on emission levels that is so desperately needed, the investors need to move in the same direction. And to achieve this, I propose there are 4 barriers that needs to be tackled. The first barrier, and the fundamental one, is measurement. If you ask an investor today, what does a Paris-aligned investment actually look like? There will be very different answers. And we are not able to really measure the climate profile in our investment portfolio in a very good way. As an example, if you want to calculate how much CO2 does an investment emit per $1 million in revenue, then by using that calculation, a coal company with 50 million tons of CO2 can look better than a consultancy company with only 900 tons of CO2 emitted. The measurement challenge explains why investors' net zero targets are defined in very different ways. And this is why we need science-based approaches. One that makes a connection between how we measure emissions from our investments and make a connection to global emission levels in the real world. Unless valid measurements are used by investors, then the mass movement will not be as strong as its potential. But getting the right measurements can take a very long time unless we tackle the second barrier, transparency. Unless there are more transparency with regards to how investors are actually measuring Paris alignment, then we will miss out on important knowledge dissemination and sharing between investors. No one has the perfect solution today. It will need to emerge over time. And that is why I think that the financial community should think of net zero targets as they do with open software development, where publicly accessible information underpins the creation of new ideas, new solutions, and innovations. And we need transparency for stakeholders, such as customers, NGOs, media, and politicians, so they can make the final judgment on how investors are actually aligning their investments towards the 1.5 degree target. Under the right conditions, transparency in itself can be a vital driver for creating a race to the top amongst the largest investors in the world. Then, the third barrier, creating impact. So there's a discussion in the financial community about whether divesting from the companies with the highest emissions is a good strategy to reach net zero, or if investors should remain invested in the companies and try to change them from within. Neither of these strategies will succeed unless if there is a critical mass of investors that cooperate to work and try to achieve the same changes in the companies. If investors can agree on what companies should do, then they can enforce that view by collectively voting together to actually change the companies from within. So let's say we overcome these barriers. we solve the measurements and transparency issue, and there is a large amount of movement amongst investors that collectively work together to actually change the companies they have invested in. The question is, how big of an impact can investors have in tackling the climate emergency? That leads us to the final barrier, politics. It is unrealistic to expect that the financial sector alone should change the current emission trends, and specifically so for institutional investors who manage money on behalf of others, such as pension funds. This is because investment portfolios mirror the real economy. And if the real economy is going in one direction, then investing in the opposite direction may lead to unacceptable high risk and lower returns. Think about it. Would you want to gamble with your mother's and grandmother's pension? Of course, the financial sector can impact global emission trends in isolation from politics, but it has its limits. Rather, I think it's useful to think of the financial sector as a catalyst, one that amplifies climate regulations. If fossil fuel subsidies dropped, then investment will fall. If high carbon prices are introduced, then capital will shift from financing brown activities to greener activities over time. But in the absence of such policies, there will always be an opportunist in the market that will take advantage of profitable opportunities. The politicians must start seeing the mass movement of net zero commitments as a great opportunity to get headwind for introducing more progressive climate policies. Failing to do so, then the mass movement will not reach its true potential. But before pointing at the politicians, the financial industry should address what can be done from within the industry. Measurement, transparency, and more collective action that actually change companies and markets. The stakes are too high to make climate an arena for marketing or brand positioning. What we need is a mass movement of investors seeking the truth on how it can impact global emission levels.